Hey guys, my name is Stephy Lim. I'm your instructor for ACCA Performance Management, Financial Management, as well as the Advanced Performance Management. Now, so are you preparing for your upcoming December 2020 exam? If you are, then do you face any of the problems or difficulties in preparing for it? Now, not to worry, because in my upcoming intensive revision course for ACCA PM, FM, and APM, I'll be able to walk you through on the theories as well as the computational questions. So, what are you waiting for if you aim to make a pass in December 2020 exam? Stay tuned for my upcoming videos and I'll be able to show you the right way and the exam technique to make a pass. Bye for now. Thank you very much and see you real soon. Thank you.
Hello everyone. Now welcome to our ACCA Financial Management demo session. Now my name is Stephy Lim. Now today I'll be able to show you two sections of this video. Now the first part is on the learning phase. Now that's where we can see most of the key definitions, the concepts, or even some of the important adjustments for a particular topic. And what about the second part? Now the second part, that's more on the revision phase, where I'll be showing you how to debrief a particular exam question. And of course for today, I have already selected this topic. And let's have a look at investment appraisal with inflation and tax. Now I believe that for most of the FM candidates, that you're pretty familiar with this part, knowing that these forms most of the time one of the questions in section C, and that's what we call as the constructed response question. Now of course in this part of the video I'll be able to demonstrate that how we calculate the MPV for a particular project. So let's have a look at the pro forma for the MPV evaluation. Now first of all, let's assume we are considering there's a new project of investment for a business. And let's say we assume that year number 3 is the end of the project. Now, so we have to start off with something to do with the sales. Now, of course, student may be asking that, Steffi, now can I just check with you that how would you calculate the sales figure? Now, listen carefully. In the exam question, now there will be the circumstance in which sales inflation will be provided in terms of the percentage. Now there may be like 3% per year or probably 4% per year. Now that depends on the exam question. But what we know is always to take the sales quantity or the demand to multiply with the selling price. So that's on the sales part. And number 2. Now of course, we're going to see we have to minus off both the variable and fixed cost. So in your examination, variable cost, it depends on the volume of sales, which what we call as the demand. Again, now what about the cost inflation? Will that be provided in the examination? Yes. And normally, that will be a different percentage as compared to sales. And of course, class, now both the variable and fixed cost will be subject to inflation, if there's any. So therefore, bear in mind that it starts off from year 1 and without any sales or cost figure to be presented in year 0. But it's just all the way to the final year, which means year number 3. Now, so what do you expect to see right after this? Now that's how you get the taxable cash flow. And bearing in mind, class, that most of the time, as what you can see, it's we have to take into account the taxation figure. Now let's say, class, that for taxation, the candidates are required to refer to the questions that what's the rate for the tax. Now it could be somehow to see probably in the final paragraph. Now the tax rate could be like 28%, 30%, right? So let's assume if it is a 30%. Now, class, please remember, now in the exam question where they'll be stating this. Are you going to pay tax in the same year or deferred tax, or in the sense that they pay tax 1 year delay? Now, so if they're paying tax 1 year delay, this is what we can witness here. And I can tell you, class, that most of the time you will be seeing that they're paying tax 1 year delay. So year 1 tax to be payable in year number 2. Now, not to forget as well, that is somehow important for us to get these calculated. Now, that's the tax benefit or the tax saving on the TAD. All right, so that's on the tax liability depreciation. This very much depends on the method of depreciation. Are you going to use the straight line method or the reducing balance method, as these will give different set of the answers? Now, not to worry, class. That's because later, when it comes to the answering of the question, we'll be able to see these adjustments. But bear in mind, since it's a form of the tax benefit, you could see it happened or it arises, okay, from the same year of tax payment. So if you're making any tax payment year number 2, and that's when you will start claiming the tax benefit. All right, so 1 negative and 1 positive, right? Negative for the tax payment, then positive for the tax benefit. Okay. Now I'm going to move on now to scrap value. The scrap value represents the terminal value of the investment, and which you can see that it rises normally in the final year of the investment. And of course, class, we're talking about the investment cost. So this investment cost is where we have to place under the year 0 column, and knowing that that will be the investment, right, cost to be made or incurred immediately. So that simply means now in year 0. And what about these year 1, 2, and 3? That means like a year later from now, or 2 years later and subsequent years. So as such, class, from here we'll be able to move on, assuming if it's for working capital. Okay, now try to think and see working capital. Now will be seen as a form of capital to finance the short-term investment. And of course, class, if you see any of the investment in the working capital that it starts, say for example in year 0, and then subsequently, and assuming that without any inflation, so towards the end of the investment, you'll be able to recover a full 500. Now that's assume, all right, that is to assume that we're making a positive NPV for these investment. So therefore, by itself, these will be recovered. I'm talking about the working capital, all right? Now, so of course, now students may be asking this question, and it's like, Steffi, now can I just check with you that is it possible for you to let me know that whether is this working capital recovery taking place? Now that's a very good question that most of the candidates must be aware of that. Now if you have tried out or attempted any of the past exam questions, you realize that whenever there's any adjustment to do with working capital, now they may be telling you how much is the initial investment, but there is no further information about the recovery. So if that is the case, that's what we call as a form of silent, all right, silent requirement, which means no further information is provided. Now, if that is the case by default, we will then have to recover. Okay. Now, of course, in the past, now there was question where it's stated with the following statement. For example, when they mention the recovery of the working capital is to be ignored. Now, if they mention things like these, which means in the final year, we would just have to place a 0 and assuming there is no recovery of the working capital. All right. So, of course, the assumption is important here, and that's how you'll be able to see, just in case if there is anything to do with inflation. So let us see. So what about it is with a 10% inflation, say for example? All right, if it's with a 10% inflation, so when it comes to the second year, or I would say year one, to maintain the purchasing power, we would then top up a 50. And of course, now in total, the level of the working capital investment comes to 550, and where we will be able to top up a 55 as the 10% of the 550. And let's assume recovery is there. So what are we going to do? Now, we would recover 605 in total in year number 3. Okay? Now, so do you think it's common to see these working capital adjustment in most of the investment appraisal question? The answer is not really. Okay, so occasionally you'll still be able to see these, but it's good for us to cover everything, and just in case any of them coming out in the exam. All right. Okay, great, ladies and gentlemen. So from whatever adjustment that we have made, and subsequently you'll be able to see how to derive at the net cash flow then. All right, with all the plus and minus here. And of course, not to forget about the discount factor. Now, so for this part of the discount factor, and that's what the students will have to take note, we're talking about the cost of capital as means to discount all the net cash flow into the present value. Now, so I'm going to have a question. So what discount factor or the rate that we should be using? All right. So on the same page, they'll be able to see the very last part of these on the description, talking about which discount rate or factor should be applied. Okay, let's see. Now, I'm pretty sure that you know exactly this part, which is a formula to be used to identify should we go for nominal cost of capital or the real cost of capital. So let's see. Now, so that's very much depends on the adjustment. And let's start with the first. Now, I would say that in the exam, this is the adjustment that comes out most of the time. All right. Now, so if let's say it's a question that is with inflation, we will then have to use the nominal cost of capital. And please bear in mind, now this is also known as the money cost of capital or the money COC. Okay, let's see. Now, so how does it work? We have 1 plus n. So n is actually the nominal cost of capital. We have 1 plus r, and r means the real cost of capital. And what about h? Now, h here represents the general inflation that we could see most of the time. So, of course, in the exam itself or the question, if you ever see any questions from IA, please be reminded that there could be 3 different inflation rates given in just one question. That could be the sales inflation, the sales price inflation, it could be the cost inflation, and the general inflation. So make sure you use and apply the right one here. Okay? Now, so what you can see is that the real cost of capital is before the general inflation. So therefore, you will have to multiply by the general inflation rate and subsequently to derive at the nominal rate. Okay? Now, so how do you know that should you be going for these nominal cost of capital or should you go for these real cost of capital? Now, if the question, it comes up with inflation adjustment, now, class, please apply the nominal rate, but not the real rate, okay? But just in case, if they want you to calculate the MPV based on real term, and how would you calculate this real rate? Now, that's quite straightforward. That's when you use your nominal rate to divide by the general inflation rate. So subsequently, you will then be able to derive back at the real rate cost of capital, okay? Now, so I would say that most of the time in the examination, that which one comes out more frequently? Is that the nominal rate, the nominal term, or are you looking at, say for example, the one that's to do with the real rate? Now that's a very good question. Now the answer here is most of the time the one coming out is the nominal cost of capital. So that's what we're going to see here. All right. Now, of course, not to forget, now once you have got this discount factor identified, and eventually you will derive at the present value. Now, class, bear in mind for this present value here, and that's how you derive at the final NPV. So when it comes to this final NPV, we are going to show whether is this positive or a negative figure. But of course, please analyze the past exam question requirement. If you're only required to calculate, and that's where we were stopped after calculation has been done. But if they need you to evaluate or to comment, and please make sure that you have to come out with a comment that whether should we accept this particular project. All right, so it seems to be really important, especially when you are here to score probably in the range of let's say 7 marks to 12 marks, all right, for the past exam questions in section C. All right, that's fine. Now, so of course, now based on what I have just discussed and what I've just briefed, now we can see that I have looked into the sales, variable costs and fixed costs with different types of the inflation. So I've just mentioned that. So for the tax benefit, it's either when you go for these straight lined or the reducing balance. So we say in order for you to get this tax benefit, it's when you take the TAD to multiply by the tax rate. So the tax rate could be, as I said earlier, 20% or 30% and so forth. And of course, tax payable was the one that I mentioned earlier, all right, following the tax rate, and it's going to be a negative cash flow, okay, as well as the working capital that we were talking about, whether to recover or not, as well as any inflation or without inflation adjustment. Okay, now great. Now, so students shouldn't spend too much time here, especially in preparing the answer for this investment appraisal, especially in calculating the NPV, because it's in a way quite simple. Now, so I believe if that's all right for everyone, we will be entering into the revision phase up next. In order to look at a past exam question, we will be able to debrief on the answer itself. Okay, so let's go and move on to the next part. Thank you. Hi everyone. Now welcome back to our section B of the revision phase, and that's where you can actually have a look at the past exam question as in how we apply back into the scenario. Now first of all, you're required to calculate the nominal NPV of Pink's company's investment project and to comment on your findings. Now just bear in mind that we are not just here to look into how much is the NPV, but of course we have to come up with a conclusion whether or not we invest in this project. Now it says here that Pink company, it's a large company listed on a major stock exchange, and in recent years the board of Pink's company has been criticized for work, corporate governance, and 2 of the company's non-executive directors have just resigned. A recent story in the financial media has criticized that the performance of the company and claims that the company is failing to satisfy the objective of its key stakeholders. So I guess they have to address the concerns and even the issues of them. Now, Pink's company is appraising an investment project which it hopes will boost its performance. The project by itself will cost $20 million, payable in full at the start of the year. Now, so always bear in mind, if you get to see at the start of the year, that means it will happen in year 0. Now, we continue with this part. The The project life is expected to be 4 years. Forecast sales volume, selling price variable, and fixed costs are as follows. Now, class, as you get to see, that's the pattern or the style of the examiner by coming out with all this data from year number 1 to year number 4. So let's see. Students will be given the sales quantity and together with the selling prices, and that's for us to calculate how much is the total sales for the 4 years' time. And of course, you'll be given the variable cost per unit. Same goes to the last part, which is the fixed cost. Now, of course, imagine that selling price and the cost information are in current price term. So what is this current price term? That means before the inflation. So that's why they say that's before applying the selling price inflation of the 5% per year. Now, what about the variable cost? The variable cost inflation of 3.5% per year and the fixed cost inflation will be at around 6% per year. Again, we say it depends on the exam question. Now, in this case, they have given you 3 different rates, but where somehow in certain past exam questions, they will only provide 2, which we have the sales price inflation and variable cost inflation. Then what about the fixed cost? They may be telling you that the fixed costs are already in nominal term. Now, move on. The Pink's company pays corporation tax of 26%, with the tax liability being settled in the year in which it arises. So class, no delay in payment. So the company could claim the tax allowable depreciation on the full initial investment of the $20 million on a 25% reducing balance basis. So the investment project is expected to have 0 residual value at the end of 4 years' time here. Okay, now, as we actually get to see from this question, now basically there is no information about the working capital, so this is the first thing you get to know. And on top of that, class, not to forget, now they are looking at reducing balance basis. So what we're going to do with that, these will only apply to 20 million. Now, you know, some of the candidates in the exam, what will they do is they try to include the value of the working capital, and in order for them to get it depreciated as well, or to claim the so-called tax saving. But the problem is we do not claim tax saving for working capital except the non-current assets, all right, or the long-term investment. Now, so at last, Pink Companies has a nominal after-tax cost of capital of 12%. That means this has already considered the inflation impact, and there's a real after-tax cost of capital of 8% here. So we say that in this case, the general rate of the inflation is expected to be at a 3.7% per year, now which is for the foreseeable future, all right, as what you get to see. Now, so one thing that is pretty clear, it's on this part right now, class. Now, we know currently they want us to go for the nominal NPV, and that's the reason why we are going to apply the 12% for the calculation. But try to imagine if they are looking at the real net present value in real term, that's where you should take this nominal value or nominal rate to divide by the general inflation rate to derive at the real cost of capital, if there is any. But I believe that in this case, we're not required to do so, since we are talking about just the nominal NPV. All right, great. Now, so class, now what I'm going to do right now, as I mentioned, is important to show you and to debrief on this part as in how these will affect us. Okay, now we would expect a question coming out in section C, right, looking into how to calculate these NPV itself. So what we're going to do now, class, is to start off with the pro forma. So as we mentioned, is important. Let's say to start off with the sales revenue. And we know, class, there will be variable cost to be included here. The fixed costs, not to forget. And this is what we call as the cash flow before tax, or before tax cash flow. That's all right. Okay. Now, so class, not to forget about these. Now, upcoming, that's going to be the taxation. So when we are looking into these, we know that the tax rate is currently at 26%. So that's why here we're taking this 26% here. And we will be looking at the tax saving. Do you agree? Now this tax saving or benefit is on the TAD, or the tax allowable depreciation. And of course, class, ask yourself any other items to be included. Now we know there is no scrap value, there is no working capital. So the next figure that we're going to show here, it would be the investment cost. Can you see that? No, so that's straightforward. Now that will be important for us then to move on to the net, all right, cash flow for your information. All right, so from the net cash flows, that's how we apply the discount factor, and that's based on the nominal rate of the 12%. And finally, this is how we get the present value. All right. Now, not to forget about the final NPV and its command. But for now, what we can do is to start off with the first three items. So let's see. Now, make it quick and fast. We always say there will be no sales, all right, or even any of the costs right there in year 0 itself. So that's going to be 0 here. And not to forget, what about to get the sales figure? Now, if you refer to the model answer, and that's normally what the examiner would include, especially a specific adjustment right here, the workings. Okay, so let's see. Now, for this part of the workings, all right, we're going to have N1, which is the sales figure. So we say to derive at the sales figure, we must always start from the sales volume or the demand, as we need to multiply with the inflated selling prices. Okay, now, so what we can do, we can come up with something like this. Now, just have to use and come up with the inflated price that's based on per unit. Now, so class, as you can see, our current price in year 1 is 125, but the price by itself will be inflated by 5%. So we can actually use 125 and then with 1.05, as you can see here. Understand? Now, I hope you can actually follow us from here. That's how you get 131.25. Now, let's say the next it's like 130, 40, and 120. So it's the same thing here, class, that we're taking this 130 and 1.05 power of 2 in the second year itself. Okay, great. Now, so you know what? In terms of all these unit prices or the cost, we'll try to keep it to 2 decimal places. All right. And of course, not to forget, we have these 140 as well. All right, so let's see. So we have once again 140. So 140, and then with 1.05, and of course power of 3. Okay, that's not a problem. And finally back to the 120. So what we can do is we can even copy and paste the same formula. So that's 4 and just amend it to 120. Okay, that's great. So we have these 145.86 in the first place, where we get to see, class, that is somehow important. All right, so that's somehow important if you have the demand to be placed here, because we are going to get the total revenue for your information. All right, so how much is the total revenue in this case? All right, so from there we can actually see that in order for you to know the demand, that's where the question will show you this. All right, so let us see. Now, so we have about like 300,000, 410, 525. Am I right? So let's see. Let's fill in the blanks here, as we're going to show everything once again in thousand. So let's start with these now. For example, now the first, as we mentioned, we have 300, 410. So on top of that, we have the 525 and 220. 525, 220. Okay? Now, that's how eventually to derive at the total revenue or the total sales. And that should be the inflated revenue. All right? So taking these and multiply by the volume. Okay, great. And this is eventually how you derive at all the sales and to be placed on top shortly. Okay, now, so what we would then suggest to the students is to adjust them to the nearest thousand. All right, to the nearest thousand. So that's how we get this figure for your information. All right, now, so not to forget, for those who have done, what we are going to do right now is to move on to the next part as well. Okay, now, so I know we can actually fill in the blanks with all the figures here, because you know what we can do? You can try to click on this, and so that it comes back to this part, it comes back to this. All right, now, I mean, just in case if you are going to change any of the figures or the manual workings, you'll be able to see there is the direct or automatic adjustment made by Excel. All right, just in case if you amend any parts of your workings, right there. Okay, great. Now, so this is done. Of course, what you all will have to continue is to look at these, and number 2, looking into the variable cost. So what I'm going to do right now, same thing here. Now I'm going to use these as the VC or variable cost. And don't forget, class, that somehow we still need the inflated cost from the first year to year number 4. And of course, class, demand wise are all the same. So that will be posted on the second row. But here we're looking at the inflated cost. All right, for the variable cost. And finally, we're looking at the total variable cost. Okay, that's all right. So how much is the inflated cost then? Let us see. The variable cost by itself is 71. All right, as you can see here, 71 per unit. And the variable cost inflation is 3.5% here. So 71 and of course 1.035. And in which you'll be able to get the answer for these. So we adjust it to 2 decimal places. Alright, so that's where you can actually see class like 73.49, it's the first. And this is based on the current variable cost of the 71. And then we try to inflate it by the 3.5%. Now, what about, on the other hand, the rest of it, that's going to be like 71 as well. So we try to make it easy. All right, so just try to copy and paste it here. And this is going to be for year number 2. All right, that's not a problem. So we just have to paste it and continue to change this to year number 3. All right, that's fine. And of course, we're trying to inflate it, all right, to year number 4 for your information. So we should know to derive at this total variable cost, we just have to multiply by the demand. So taking this and multiply with the individual volume here, that's the variable cost. Now once again, I'm going to adjust it and to round it to the nearest thousand. So That's not the problem. It's not an issue for us to be posted back to these pro forma. Okay, so that's fine. Now I'm just going to click on that, and of course more to go, knowing that we have to adjust them like one by one. Alright, so that's where you get marks for each category. Like for sales, you're going to get 1 mark for each of them. And of course, subsequently later, we have to continue with these, and number 3 for the fixed cost. Alright, for the fixed cost. Okay, that's alright. Now, so let's have a look at N3 if it's for fixed cost. So what you guys have to take note, don't forget, that's very much to apply the right inflation rate again. So I'm going to copy and paste here, and we need to know how much is the fixed cost in the first place. Like I think they've given us the figure in total. So let us see, 3,3132 back to 3. So that's like 3 million, 3.132 and back to 3 million. Yeah, that's all right. But somehow we need the inflated fixed cost. So let us see that how many percent of this inflation, if you are seeing it. I think that's like 6% per year. So we're taking this figure, and of course to multiply by 1.06 in the first year, and we have to move on. Alright, multiply 106 and power of 2. Alright, because we get to see that's for the second year. And not to forget, class, if we're going to continue with the third year. Alright, so that's clear. And of course, finally, we get to know that's a final year with a 6% inflation. Alright, with a 6% inflation. So that's number 4. Alright, that's number 4. Now, so again, I think it's time for us to derive at the taxable cash flow really quickly once you are done. So let me just show you these then. Now that's the 3180. Number 2, it's the 3483. Number 3, let's see, 413, or sorry, it's 3811. And finally, if let's say we're looking at the 3787, that's all right. Okay. Now I think it's not the problem now for us taking these sales and minus off the variable cost and the fixed cost, and class, congratulations. And that's how you get the very first part of it. All right. So I'll try to adjust it nearest 1,000, and you've got the first level of the figures, which is the cash flow before tax year. Now, so expect to know that from whatever we have, from the cash flow on top, and taking a 26% as the tax. So we just have to drag all the way, and that's 2698 for information for tax. And not to forget, class, we will continue now with N number 4, which is the fourth adjustment, in order for you to know how to get this tax saving on the TAD in this case. So now let's see, this is N4. We're looking at the tax saving, and we're making use of the reducing balance method. All right. Okay, let's see. And you know what? Now we're going to claim the tax saving in the same year where all cash flow arises. So it starts from year 1, 2, 3, and 4. So that's all right. But the first thing you have to do is to get the TAD calculated first. All right. So that's the first thing. We have to get everything ready. And of course, subsequently, I will be having these tax saving by taking the TAD to multiply by the 26%. So what we can see is number 1, first of all, how would you be able to derive at the TAD, or the tax allowable depreciation? So you know what? coming back to here, now we know that for this TAD, we are taking initial investment and then of course with a 25%, all right, from it. So what we can do is that number one, now taking this 20 million with no accumulated depreciation, and we're claiming a 25% here, as you can see. All right, so that's your tax saving. Let me just repeat again. How do you get the tax allowable depreciation using the straight line method? All right, that is the one. So not to forget, once again, by the use of the investment value, all right, then subsequently we get to know class 2 minus of accumulated depreciation of 0 the first year and multiply by the rate. Not to forget, taking this figure and we're going to multiply by the tax rate 26%. Okay, great. Now, so what about the subsequent year? That's quite straightforward because we're taking whatever earlier TAD that we have, the previous TAD, and since it's reducing balance by 25%, so therefore what we can do is to multiply by 75%, which means reducing balance by 25. Okay, now so we can just drag all the way here, and of course the coming year we're going to do the same thing, taking 75% of this. Now what about the final year? Okay, now when it comes to the final year for reducing balance basis, there is always a formula to be used. For example, we're taking cost minus of any of the accumulated, all right, accumulated depreciation. Now that's what you have to note, and to minus of any of the scrap value, all right, if there is any. So if that's the case, I don't think there's any scrap value in this question. Now, so we'll be taking the cost here minus of accumulated depreciation from the previous 3 years. Can you see that? No scrap value. That's going to be 0. There'll be no scrap value. And as such, we gave it this 8437. And that's what we say, claiming these as the balancing allowance. All right. So what we can do, class round it, and congratulations. And this is how you derive at tax saving. All right. So let's see. Now we are going to fill in the blanks again and making sure that the first is like the 1.3, and that's going to be 975, just to show. You know why? Because when they're marking your paper, your answer, and they'll be able or simply to click on the cell and it knows exactly from which part the answer comes from. All right, so it's going to be positive, the 2194 as the tax saving. All right, now what about when it comes to the first year? So this first year by itself, we know that's like 20 million. All right, so in year 0 we've accounted for that, so be really careful when you're handling this part. We're going to minus off tax, we'll add back the tax saving, and of course we have to take into account the investment. So that's how you drag. Okay, so this is all right. This is all right for you to get the answer, which is not a problem at all. Okay, so congratulations. Now you guys have just got the net cash flow already from the answers. And you know what? Now, so what we can do right now is to apply the discount factor, and we're talking about 12%. Now, students will be given the present value table as well as the annuity factor table in the exam. So what we can do is we can anytime refer to that table and then subsequently to apply them accordingly, and so that we'll be able to derive at the final NPV. All right, that's where we have to come up with a command for your information. So let me just type this in. I've included this, and congratulations class. From here, taking these and we're going to multiply with the discount factors over the years. Okay, let me once again by adjusting it, and you'll be able to get the sum of all the positive and the negative figures. All right, because we're going to derive at the final MPV real soon, and this is the one. Can you see that? Right, this is the one. So what I'm going to do is, to come up with the final answer, and that's the MPV. That is actually in thousand. So it's close to about 33 million. That's your final answer. And of course, should we accept this project? The answer is yes. So we say the investment is assessed to be financially viable since it brings a positive MPV of, okay, that's what we say, plus 333, all right, 347. So it's close to about $33,347,000 for your information. Okay, now, so bear in mind, whenever we're looking at a question like this, just have to take note, especially on the marking scheme. The students will still be awarded marks when it comes to the command part, all right, despite the fact that they may have calculated a wrong MPV, as we know that the command has to be made based on whatever MPV figures that they have derived on top. Okay, so that's why students may be asking, is it important for us to come up with a command? The answer is yes. Okay, now, so class, I hope you learned something from here, and this is what we say how you come out with the whole set of the MPV. The first step is always to come up with all the pro forma. All right, so just follow the orders, the sequence. Fill in the blanks, of course, by showing the workings. All right, come up with the inflated figures, if there's any, inflation, cost, revenue, as well as the tax saving. All right, now, so this is how you get, or probably to see, by answering this question, you score 9 marks in section C. All right, so I hope you learned something from here and enjoy the video. Now, for more relevant adjustments or topics to be covered, please stay tuned to our latest or upcoming ACCA Financial Management IRC recorded videos for December 2020 examination. Now, once again, my name is Stephy Lim, and I hope you enjoyed the video. Now, so let's see what we're going to cover up next in our revision video then. All right, so bye for now, and thank you very much.